Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Mazi Bahadori. He's the Chief Compliance Officer and EVP of Operations with Altruist to discuss the debate on payment for order flow. Mazi, it's great to have you with us. Welcome to Trade Talks.
Thanks so much for having me, Jill. Great to be here.
And certainly a hot topic within our industry. Give us a high-level overview of the debate and why you think it misses the point.
Yeah, it's a great question. So the debate really has to do with whether payment for order flow is a good thing for retail investors. Now, critics contend that this creates a conflict of interest that puts brokers at odds with their clients. Advocates argue that it's a critical tool in helping lower barriers of entry to equity markets. The SEC jumped into the fray earlier this year largely because it had to. So Robinhood, GameStop, PFOF, these were significant areas of focus for Congress since Chairman Gensler assumed his role at the SEC. And we're also in an extreme low interest rate environment. So PFOF typically gets a little bit more interest than it historically has as a percentage of broker revenue. So everything is now on the table as the SEC assesses market structure once again. We think the debate misses the point really for two critical reasons. First, PFOF is a tool. If brokers use it to build products that help investors achieve better outcomes, get access, it's a tool put to good use. If, however, brokers are using it to line their own pockets with no regard to investors and how they're doing and whatever outcomes they might deliver, those brokers, I think, will eventually go by the wayside. And we generally think markets are better at sorting the winners from the losers than regulators are. Second, equity markets are a means, not an end. The point to invest isn't just for the sake of investing, it's to achieve an outcome. And we think there's a lot more the SEC can be doing to help investors achieve those outcomes.
If markets work well, then what are the bigger issues facing retail investors?
Yeah, so I mean, the US has the most liquid and efficient capital markets in the world. I mean, there's 100 places you can execute an order, exchanges, ATSs, brokers that internalize. Retail investors have choices, and that access has never been better. The problem, however, isn't just access, it's ensuring that retail investors are actually achieving those better outcomes. This is critical because millions of Americans continue to be left on the financial sidelines despite this access. So, in the past year, we've seen 61% of Americans couldn't afford an emergency $1,000 expense. 44% of Americans don't own a single equity ETF or mutual fund. And the majority of investors still don't know the difference between a broker and an advisor. And so the core problems that we're observing is that retail investors continue to have fundamental issues with investor education, transparency of financial advice, and confusing standards of cares in which financial institutions operate.
What's the best plan forward then?
Yeah, I mean, we can't have a regulatory scheme, obviously, that guarantees returns or puts more money into people's pockets. But we can have regulation that helps set retail investors up for success. And so we can do this by ensuring that all investors understand if they're working with brokers or advisors, revising those standards of care that are often misunderstood by retail investors. And by this, I mean, Reg BI versus fiduciary standards and so on. And certainly doing more to ensure that investors understand the risks and the costs prior to investing in any assets. Ultimately, we think the SEC could be doing a lot more to ensure that investors have access to quality financial advice, not just access to investing. And certainly at a minimum, we would hope that the commission doesn't do any action that would go so far as to reducing access altogether.
What are the options if the SEC insists on focusing on payment for order flow?
Yeah. So we think there's probably about 4 paths that the SEC could take. First is they could just ban PFOF altogether. We think if they were to take such an action, most retail brokers would still likely route to multiple venues. There are pros and cons to doing so. Retail brokers would then likely need to start charging commissions again, or they would just have less money to continue to innovate and build products. In either case, we think the net effect is going to be a bit of a detriment to retail investors. Ultimately, the retail investor will suffer if you remove it altogether off the table. Second, the SEC could ban internalization and market center routing. And so we don't think this is a likely option because we've had Reg ATS on the books for more than 20 years. Each time the issue has been studied, it's been shown to be a net benefit to investors. The third option, the SEC could take a much closer look at the NBBO, the National Best Bid and Best Offer, potentially look to revise based on current market practices and technologies, including revisions to odd lots, potentially removing round lots. There's a lot that we think could be done there. And then fourth is more disclosure. right? The SEC is always a fan of disclosure and transparency. And so really doing things that help investors understand both the cost and the value of order flow and their brokers' order routing practices. I think ultimately, if the SEC insists on pursuing this, it'll likely be a combination of the latter two, where they pursue a course of action to both modernize and focus on transparency.
All right, Mazi, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.